In this video, I'll be talking about EBIT, which is earnings before interest and taxes, and EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So let's get started by EBIT. So let me just go ahead and write down the heading EBIT. All right, perfect. Now, EBIT and EBITDA are two key financial metrics used to evaluate a company's profitability. While they are closely related, they differ in the specific expenses they exclude from the calculation. So let's get started with EBIT. So this measures a company's operating profitability by calculating its net income before deducting interest expenses and income taxes. So let me just go ahead and write down the formula. So EBIT, so these both ratios have their own formula. So EBIT is net income plus interest expense plus income tax expense. Income tax expense. So this is the formula for EBIT. Now let's look at an example. So let's say if a company has a net income of $100,000, interest expense of $20,000, and income tax expense of $30,000, and you're asked to calculate its EBIT. Well, simply it's just gonna be 100,000, which is our net income, plus our interest expense, which is $20,000, and our tax expense, which is income tax expense of $30,000, and this adds up to a total of $150,000, which is our EBIT, or otherwise known as earnings before interest and taxes. Now, you might be wondering, why is EBIT even important? Like, why do companies even calculate it? So I'm just gonna go ahead and write down some of the key points on why companies do it. The first one is operating performance. Now, EBIT focuses on a company's core operations, excluding factors like capital structure and tax rates that can vary across industries and companies. Then we have comparable analysis. Comparable analysis. So EBIT can be used to compare the profitability of companies within the same industry, even if they have different capital structures or tax rates. Then we have valuation. So EBIT is often used in valuation multiples such as EV/EBITDA to estimate a company's enterprise value. So that is pretty much it for EBIT. Now we're gonna go ahead and look at EBITDA. So EBITDA. All right. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It provides a broader measure of a company's overall profitability by excluding not only interest and taxes, but also depreciation and amortization expense. Now, let's look at the formula. So I'm just going to write it here. Formula. So the formula goes like the same as EBIT. So I'm just going to write the same thing again. Net income plus interest expense plus income tax expense. Alright, so this is till here, it's the same. Now I'm going to change the color so I can show you where the main difference comes in. Then we have depreciation expense. So I'm just going to write it here. Depreciation expense plus amortization expense. So this is our formula for EBITDA. So as you can see, we have an additional depreciation and amortization expense added. Now let's go ahead and look at an example. Now, if a company has a net income of $100,000, interest expense of $20,000, and income tax expense of $30,000, depreciation expense of $15,000, and amortization expense of $5,000, and they're asked to calculate its EBITDA, so let's go ahead and write down the expression we're going to be using. So, 100,000 plus 20,000 plus 30,000, and then we have an additional 15,000 plus 5,000. 15,000 as depreciation and a 5,000 for amortization. Now, if you add all this up, you're gonna get a grand total of $170,000, and that is our EBITDA, or earnings before interest, taxes, depreciation, and amortization. Now, again, you might be wondering, why is this even important? So let's go ahead and write down some reasonings. The first one is cash flow proxy. Cash flow proxy. Now, EBITDA is often used as a proxy for a company's operating cash flow, as it excludes non-cash expenses like depreciation and amortization. Then we have valuation. So, EBITDA is frequently used in valuation multiples to estimate a company's enterprise value. Then we have leverage analysis. Leverage analysis. So, EBITDA can be used to assess a company's ability to service its debt, as it provides a measure of earnings before interest payments and other depreciation and amortization expense. Now, we're going to be looking at the key differences between EBIT and EBITDA. So EBIT is main focus is on operating profitability, while EBITDA has a focus on the overall profitability. Now let's look at the exclusions. EBIT excludes interest and taxes, and then for EBITDA it has interest, taxes, depreciation, and amortization, and EBIT has interest and taxes. And for the cash flow proxy, EBIT is less direct and EBITDA is more direct. And for valuation, EBIT is used in valuation multiples, while EBITDA is frequently used in valuation multiples. Now, you might be wondering, which metric is better? Now, the choice between EBIT and EBITDA depends on the specific analysis being conducted. EBIT is more useful for assessing a company's core operating performance, while EBITDA is more useful for estimating a company's cash flow and valuation. Now, it's important to note that while EBIT and EBITDA can be valuable tools for analyzing a company's financial performance, they should not be used in isolation. A comprehensive analysis should consider other financial metrics such as revenue growth, profit margins, and debt levels. So these two are just one of the few ratios that we have in accounting. Obviously, when you're carrying out an analysis, you'll have to consider many other, like a lot of them. Okay, so you have to make sure that you consider everything and then come up with a conclusion. So that is basically it on EBIT and EBITDA, and I hope this video helped you out, and I'll be seeing you guys next time. Peace out.